Hi, it's John Kelly. In this module, we're going to discuss external confirmations. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. And in the area of confirmations, we are at particular risk of being ineffective and inefficient. Now, the standards give us guidance. They give us guidance on the procedures we are to use when sending confirmations, give us guidance on what to do if the client says, no, you may not confirm that account. And that, as long as the client has a good reason, it's going to annoy the customer or for some reason like that, that can normally be worked around. We can find another way to test that particular balance. And it tells us how to summarize the results. Negative confirmations, let's talk about those first because those can actually work quite well. If you're dealing with a utility or a financial institution, you're contacting every customer and asking whether there's a problem. And I actually had an experience with a credit union client where one member wrote back and said, you know, you guys told me that you changed the interest rate on the 1st of the month, but you didn't actually get around to doing it till the 15th of the month, and you owe me 15 extra days interest. Now, I was surprised that any customer was paying that close of attention. They had phoned the credit union and complained, but of course they got a low-level person and nothing got done. When I, as the auditor, contacted the chief financial officer, and it actually didn't turn out to be a lot of money. It wasn't in the end a material amount of money. But the credit union thought for a bunch of reasons they should correct it, so they did. So negative confirmations can actually work quite well in that kind of situation. Now, bank, accounts receivable, and other confirmations are not required by standards. They're an auditor favorite. We love to send them out. We know they often come back wrong. We know that bank confirmations often come back with incorrect information. But in the face of that, we continue to send them. We should ask the question, is this an effective technique? Are accounts receivable confirmations reliable? And research has shown that at least 50% are returned without checking. Later research has shown it was worse than that. And the important research was done by Paul Castor back in 1990. Now you say, that was a long time ago, 1990, 20 years ago. Well, that study and others done since have influenced standard setters, and it's influenced standard setters enough to add the following sentence. There is a risk, however, that the confirming party may reply to the confirmation request without verifying that the information is correct. That's 505A5. So the research at least has got that statement into professional standards. Now let's keep that in mind and then think about how effective confirmations are going to be, and let's think of accounts receivable confirmations. Confirmations address the existence assertion. Does the balance exist or not? And in accounts receivable, valuation is often the higher risk of material misstatement. So confirmations don't help us with what is probably the higher risk area. And confirmations look like they're really easy to send. We send out 30 confirmations at the beginning of the audit. It takes not very long at all. The problem, of course, is then at the end of the audit, we only get 10 replies. We've got 20 to clear, and we're at the last minute, and we're dashing to try to clear the last those 20 non-replies at the end of the audit when we're under time pressure. And then the other question is, if we have to assume that 50 or 60% of confirmation requests are signed without being checked, and we sent 30 and got 10 replies, how do we decide which 5 of the 10 or 6 of the 10 were signed without checking? And what do we do? Do we have to check all 10? So it's an interesting question. The other thing in terms of audit strategy, we often pick large samples for accounts receivable. We say, oh, let's pick a 95% confidence sample. Well, that ignores all the other evidence we've got about accounts receivable. We've done analytical procedures, we've done control testing, we've already got some evidence, and we don't need to be testing at 95% confidence. Inherent risk of high is often considered to be 60%, so we're doing way too much work with a large sample. And particularly if risk of material misstatement is low, we don't need to be doing a large, high confidence sample. So the result is we're over auditing, we're addressing a low risk assertion, and we're using an unreliable procedure. Now, what can we do instead? Well, subsequent payments, for instance. And I had a client. Now, because of the nature of the people they dealt with very large and reliable suppliers who paid them electronically. And within 30 days of year end, all the receivables, almost virtually all, 99% of the receivables were paid. So it took an hour or two, but you could sit with the bank statement and the deposits and the check vouchers, and it took an hour or two to clear all of the receivables as having been paid. Now that deals with both existence and valuation and maybe even completeness. And yeah, we over audited, but it only took 2 hours, and we got some pretty excellent audit evidence about pretty much all of the assertions for accounts receivable. So in summary, receivable confirmations or confirmations in general, we get few replies. They are not reliable. They ignore our audit strategy of testing control and doing analytical procedures. We may indeed be dealing with the wrong assertion. And if there is no other way to do it, you need to find a way to deal with the reliability, or rather the lack of reliability of the process. So thanks for listening.